Welcome to the Top of Mind podcast from Altos Research. This is the show where we talk to real estate industry insiders and experts about the trends shaping the market today. Enjoy the show. Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. For 3 years now, we've been sharing the latest market data every week in our latest Altos Research weekly market video series. With the Top of Mind podcast, what we're looking to add the context to the discussion about what's happening in the market from leaders in the industry. Each week, of course, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. People desperately need to know what's happening in the housing market right now. The market was frozen so solid last fall, and then this year, surprisingly, the landscape changed again. And we want to know what's happening around the corner. So if you need to communicate about this market to your clients, go to altosresearch.com, book free consult with our team, and we can review your local market, how you use market data in your business today. All right, let's get to the show. I have a great guest today, Doug Brien. Doug is the CEO, co-founder of Mynd, a company that's on a mission to make remote real estate investing more accessible for more people. Doug got his start in real estate following the collapse of the housing market in 2009 when he and Colin Wheel founded Waypoint Homes and began buying single-family homes to renovate and rent out. They built Waypoint to a $3 billion portfolio with over 17,000 single-family rental homes over the years. Then in 2016, they launched Mynd and expect that to hit 20,000 homes by the end of this year. So we're going to talk about Mynd. We're going to talk maybe a little bit about Waypoint. We've had Gary Beasley from Roofstock also on the podcast before. So Doug is also a Super Bowl winning NFL place kicker. So I'm not sure we're going to talk about the NFL today, but maybe. Doug, welcome to the show.
Yeah, thanks, Mike. Great to be on the show. I mean, I think the first thing we need to talk about is the name of your show. Mynd, I have Mynd, you have Top of Mind. Our every other week open mic question meeting, we actually call that meeting Top of Mind. So we may have to get our lawyers together and sort out trademark.
Yeah, your Top
It's a
of
great
Mind.
name. It's a great name.
Your Top of Mind has a Y.
Right. Yeah,
right?
that's to get some real estate online, we had to switch the I for a Y.
Yeah, for sure. Well, Top of Mind is a tertiary brand for us. It's a label for our podcast, but it's really, it's what's interesting is we talk about the data a lot. And, when we're in the data, the housing market, home prices are doing this and inventory is changing and these are the leading indicators. And so what we want to do with Top of Mind is like, talk about what people understand about their market and what their perspectives about what's happening in the real estate market around the US. And so that's why, it's fun to have people like you on and why I'm going to dive in and see what your take is about. And we're not just going to talk data, but we're going to talk about, like your gut feel for the future and all kinds of things like that. So that's where the Top of Mind comes. So
Great.
let's start there though. Let's tell us about Mynd, MYND. Tell us about Mynd and what you guys do in the world and what you solve.
Yeah, so in some ways, Mynd was born out of Waypoint Homes, like you mentioned. We ended up buying and managing 17,000 homes, but as we dove into the market and just saw how big single-family rental was, saw the impact that tech could have on the ability to kind of operate at scale with a scattered site model, like we truly believe like there would be companies, if not a company, that managed ultimately 1 million homes in the US. And after 7.5 years with Waypoint, we got to 17,000. Like that's a lot of houses, but it's a far cry from 1 million. And so when we merged with Colony American Homes, Colin and I decided to step away and think about our BHAG, which was 1 million homes, and like what we would do differently to actually get to 1 million homes. And there was three big changes that we looked at. One was being asset light. Like we spent half our time raising capital to buy homes. And in some ways, that's a distraction from creating an operating system that can manage a million. The other big change was investing more in technology. It's very clear, like there's just no systems really, no software system is built specifically for single family rental at scale. And, even Invitation Homes still struggles with that. Like we had a bit of a Franken system. We use Yardi, which is built for large multifamily as our back end accounting. And then we built our own proprietary software around it. And we said, okay, let's go asset light. Let's not own any homes. And let's, instead of raising private equity, let's go raise venture capital and invest in an operating system that would allow others to more easily invest in the asset class. Because we had a sense that it was going to become an institutional asset class. And so we've basically built software and built a tech-enabled service. So people, process, and technology, we do it all. We help both retail and institutional investors buy, renovate, finance, insure, and manage homes, single-family rental homes in 30 different markets across the US. And we do it all in one platform. So we have all the data in one platform, and we can like stitch together those different activities that need to happen to successfully deploy capital in single family and harness, that data to the betterment of both Mynd and our efficiencies, our capabilities, but also to, decision making for our investors.
Yeah, so I have a lot of questions that come out of that. First, let's talk about the BHAG, the million homes. The million homes managed on the platform is really the vision. And does that mean,
Yeah, and I would actually insert the word, and Mike, this is very intentional. We inserted the word powered. So
okay,
instead of managed is, I mean, to me, sort of a 20th century, like like we don't think, like we do property management, but we don't think of ourselves as a property manager. It's something we do. What we want to do is power a million homes, and there's lots of interesting ways that we can do it. Today we're managing them, but I see a day where, homes that are owned by homeowners who the thing they think back fondly about from renting was I got to just call somebody and they like managed everything about the house. Like, why shouldn't that be a service for people that own homes? And if we have a concentration of homes in an area, and they know when we're out there and we know the work that they need, like we could actually do it probably more efficiently than anybody else. Now we're not there yet, but that would fit my definition of powered.
I like it. So
Just
powered
as an
by
example.
Mind, a million homes powered by Mind. And that actually gets me to the question of one of the other things that you mentioned there is if it's a platform, a technology platform, you're in 30 markets, uh, is like, is there a reason that you wouldn't be in, Kalamazoo or, something like that like, why does that overlap happen? Or that concentration happen?
Yeah. So it's a tech-enabled service, right? People, process, and software. So we have the software, but it's also our people. And to execute buying or managing or renovations for single family rental, you have to have people in market. So there actually, I mean, there are some like logistical economies of scale challenges that we still have, even though we have, this great software platform. Like this will be a business that will always need people. We can make our people more productive, allow them to do, higher value work. But at the end of the day, that does constrain us from being in Kalamazoo or, like we want to be in markets where we have a path to at least 500 homes
Okay, so a path to at least 500 homes that are powered by Mind.
and demand to buy. Like we don't want to be in a market, even if we could get to 500 homes, if we're just like not seeing demand to buy in that particular market. So it's really an overlap of those two criteria.
I see. Okay, and so and we can talk about specific markets in a little bit, but in general, we know which of the markets around the U.S. where investors want to buy homes, and there and so those obviously they have growth reasons for that, like that investors are interested in it. But then there's also, I suppose, some synergies that you then find because that's where people are buying. That's also the places where you have your people. Do you
That's right.
find do you find do you find that there is um, investment like arbitrage opportunity that maybe gets left on the table for areas where that don't have current, like, that aren't Phoenix or, Central Florida?
Yeah. Yeah, I mean, I think there's always like, so where the single family rental industry really is, we'll describe it as the smile belt, right? So sort of like used to be some in Southern California, but now California is so expensive. It's really Arizona through Texas and the Southeast, Atlanta, kind of up into the Carolinas. That's kind of the smile belt. So I think, there's always questions around what's the next Austin? What's the next Nashville? And so, there's always some of that. I don't know if you can clearly call it an arbitrage. Um, but I mean, look, you can talk about real estate nationally, but the story is always about the local markets. And, there's always going to be, the next wave of markets. And look, COVID did some interesting things to different markets, and it's a little bit unclear still on whether those are going to hold permanently, but it certainly opened up, work from home has had a, pretty meaningful impact on single family, and I think still has. I mean, the exurbs are still, there's a ton of demand for homes in those areas because people can get bigger homes and more land.
Yeah. So, uh, one of the things I know that you do at Mind is have analytics in the product. You have some data-driven things to help your investors understand. Um, are there uh, are there things in your analytics, either by virtue of managing 20,000 homes or by virtue of your experience, are there things in there that they're signals that you're seeing now that we should know about, or that are different from the rest of the country, or the rest of the
Yeah, I mean,
headlines?
I mean, kind of the most interesting thing that we're seeing right now is just a huge discrepancy. And California would actually be an overgeneralization. I'd say really the Bay Area. The Bay Area is just really struggling. And, when you look at the amount of cash flow that our investors are generating, I mean, we have investors that are getting $4,000 a month and just not generating cash flow. And by the way, in some cases in San Francisco and Oakland, like really rents have not recovered since COVID. Like they're still down. You're not seeing that demand. The coming back to the in the office has not yet had an impact. And so you look at like dollars invested and call it homes and multifamily in the Bay Area, and then you look at like what people are investing in the Southeast, Carolinas, Georgias, Floridas, Texas, and it's dramatically different. I mean, you're actually seeing rent growth in those Southeast markets, and we've seen rent shrinkage in the West. So if you're like, thinking about markets to invest in, I mean, we're still seeing a lot of good things happening in the Southeast. I mean, I think a general theme right now, just because people are nervous about the economy, when that happens, everyone's like more focused on renewals. Investors want to stay in properties. We're actually seeing people want to stay in properties, so renewal rates are really high. But I think that discrepancy between, call it the Bay Area and the Southeast, is pretty pronounced. And as a property management company, as you can imagine, when investors like are having a hard time generating enough cash flow to pay their mortgage and property taxes, it just puts a lot of pressure on the system. And we measure all of our activities through cases and customer service surveys, et cetera. And like we just see a lot more noise in Bay Area as a result of the conditions that I just described.
Yeah, and that's actually really in stark contrast to 2009, if I understand the Waypoint story right, which is you guys are sitting there going, "Wow, these are Bay Area homes that are at these prices are going to cash flow phenomenally in 2009," and sort of where you started buying in some of the
Yeah.
early Waypoint things. Is that true?
Yeah, I mean, it's why we wrote the book, The Big Long. Everyone is kind of, I don't know, either a real estate investor, they like want to be a real estate investor, they watch the shows, and I can't tell you how many people have said like, gosh, when that was happening, like in the back of my mind, I knew this was a buying opportunity, and I just didn't do it. And it's like, how did you guys know to go do it? And not just do it, but like go buy 17,000 houses, not like, one or two. And I mean, that's really why we wanted to write the book. And it was like, it really was this case study. And Stanford actually did a case study on Waypoint because it was so interesting. Because like we were kind of looking around, going like we were getting nervous after like a year. Like, what are we missing? Like, no one else is piling into this, and it's like we're buying Bay Area real estate near BART at 50% of replacement cost and buying 10 caps on current rent. Like rents really didn't fall. You just had a game of musical chairs. People lost their homes in a foreclosure, and then they would go rent a house in the same neighborhood. And it was like the most unbelievable business opportunity ever. And yet people were just so blinded by, the headlines.
Well, and I remember,
And the anecdotes and the fear.
yeah,
Fear was
well,
driving the day.
and I remember at that time, like, I was, we're early in Altos research, and we knew exactly what's happening in the housing market. And, but, I remember one of the fears of that time was that, is it possible to manage single family homes at scale, single family rentals at scale? Like that was unclear. And so,
Yep.
that's sort of the big risk maybe that you guys had to prove, that it could be done,
Yep.
and that you could get economies of scale, that it wasn't just, you have 17,000 houses, so you have 17,000 plumbers, you have some.
Yeah. And it really was about tech. I mean, what people forget was that cloud and mobile computing were brand new. And so whatever, in the multifamily investors' heads, it was just like that they could not get their heads around it because they're like, okay, 300 units, 5 full-time employees, like they're on site, they can do all this stuff. Like if I have 300 or 400 homes and they're scattered across, like let's say like a 5 or 10 mile radius, like how do I manage that, right? And so that's where we went and built our own system, and we did it on the Salesforce platform, and built our own customized workflows, and we made it so that anyone in the field with an iPad or a phone could see all the data they needed to see about a particular home, and we had workflows around all the activities, and they would input data into the system, and then we'd have centralized teams doing things like leasing in an office, but they had access to all the data too because it was all in the system. And what we realized was if we created like a tech-enabled service and had our own people with our own software, and you really like leverage technology in every imaginable way that you could actually make it work. The best example is leasing, right? And that would actually come up with conversations with apartment investors when we were trying to bring money into the business. And it's like, we have people come in, we have traffic come in, and then we have leasing agents in the office, and they walk them upstairs. Like, how does it work if they have to go drive someone 30 minutes and maybe, 25% of the time the prospect doesn't even show up? And like, that was real. Like, that was real. We used to have our leasing agents would do 10 leases a month. Like, that was average. And again, like we really had to lean into tech to make that work. And so at that time, smart locks had just come out, and we basically created and innovated around self-showings, this idea of you could have a smart lock, you could have an intake mechanism, you could screen them, give them a code, let them go at a time of day when they wanted. Truth is, like, most people don't want a salesperson breathing down their back anyway. I mean, you can go on Google and find out everything about a neighborhood. People have eyes and they can see it's a stainless steel stove, etc. And they can visualize their own furniture. And so we started inserting tech and automating the whole process from finding a house to actually seeing it to signing a lease. And all of a sudden we had people doing 30 leases a month. And today at Mynd, our leasing agents do, I think our record is like 120 leases in a month or something like that. Like, it's just unbelievable what we've been able to do with self-showing technology and just continuing to iterate on making it more and more efficient. And to me, that's the clearest example of like what we had to do to make that business work. And now it's interesting because multifamily is borrowing our playbook. Now in multifamily, it's not uncommon to instead of having, two or three leasing people on staff in the office at any time, they actually do self showings, and there might be one person there that can assist someone who really needs some help. But they do self showings even within apartment buildings, just A, because the experience is better, and two, it's more efficient for the operating company.
That's terrific. So would it be fair to say um, that not just the market being ready at the time, the great financial crisis market, but also the technology was ready at the time that actually made those
That's
two
right.
that made that innovation possible. That
Yeah, it was absolutely a confluence of events. I mean, the economic catastrophe and the massive price dislocation was the impetus for like people to be curious and go, huh, like I can buy a 10 cap house. Could I buy 100 of those? Could I buy 1,000? If like you have a lot of incentive to make it work. And then the fact that that tech was there, you couldn't have done it back in the yellow pad paper days. Like you send someone to a house with a list and then they write down some notes and they come back into the office and they put it in this, like that would not have scaled.
yeah. So that the fear, that initial fear that how are you going to ever get the economies of scale, that that was happening at that question that was still at that time when you guys were public and obviously buying lots of houses, still early, like most of the country hadn't started its recovery. Although we could see in our day in the Altos data, we could watch that January of 2011. We could see that
Yeah.
the first time home buyer tax credit had expired 8 months before. It was cool at the end of 2010, and then we could see 2011,
Yeah.
a year before the accepted bottom of the market. Which people could talk, like we could see it, and it was driven from, I think, a lot of demand like yours.
Yeah, and I mean, it was interesting because we raised, I think we did six or seven high net worth funds. We probably started talking to institutional investors in 2010. And our first institutional investor was the Columbia University Endowment. I think they came in 2010, and I give them a lot of credit. They did all equity, no debt, and they absolutely crushed it. But what ended up starting to, create the uptick in the market was all the institutional capital coming in. Because as soon as they saw that it was possible from companies like ours, like, maybe we had 3 or 4 thousand at that stage, it just became clear it was possible, and there was like such an incredible buying opportunity, and money flooded in. And I
Amazing.
mean, like literally I have graphics of like, the hockey stick that ensued kind of post 2011. And it's interesting because it really hasn't stopped.
Yeah, yeah.
Right, I
Well,
mean,
and
we got
let's
a
talk
little
about
bit of
that
it.
too. I'm interested in talking about the next phase, but one thing I'd like to say and I said this to Gary Beasley, who was also on that Waypoint team. Uh, when you guys decide to start buying apartment buildings, like I want to be on your phone call list. Like when you said that, that's the when that, like when you see that opportunity is turning, you let me know when that one happens.
Yeah, yeah, that is sort of the untapped middle that like is waiting for us at some point.
Did I
That's
say
a
apartment buildings? I actually meant office buildings. When you guys start
Oh,
building
office buildings.
when you
Yeah,
start
that might
buying
be a little
office
bit.
buildings, like I want to
That
be
might
on
be a
that.
little. Someone's gonna figure that one out. I don't. I I got plenty of gray hair trying to figure out single family. I don't
Yeah,
need to
you're
go
okay.
try to figure.
But like that one's now the scary one. Okay, so a couple other things though. Your book, The Big Long. So I was reading it the other day, and it's great. I love the history of the time. It's super fun. It is. I love the contrariness to the counterpoint to Michael Lewis and the whole perspective of the time. But really, it seems to me the thesis of the book is that you know uh, we want to be long, we want to be invested, especially in real estate. It's a long-term view. Um, and so, the thing that we face now is a radically different era, perhaps a whole era of the cost of money.
Mm-hmm.
And uh, how do we look at the next era And do you think, is it a blip? Is it an era? Is it, and what does it mean for all of the things right now? Tell me how I should be looking at the world right now.
Yeah, I mean, the low interest era, that really did fuel single family rental, but like all of real estate. I mean, all of real estate, and I mean, it's like we have put unprecedented. The Fed's put unprecedented amounts of capital into the system, and that money has just driven up asset values, and I think made buying real estate pretty easy. I think the era that we're back in now, I mean, if you look at where interest rates are today, I mean, it's historically like pretty average. Now, that doesn't really matter as you look back over the last 5 years. It's the relative, I mean, the pace at which interest rates went up, I think, was the fastest they've ever gone up in a short period of time ever. And so that is massively disruptive, and it's certainly disrupted our industry. I mean, right now the math is upside down. It's very hard to invest, and buy, like, let's just say a 5 cap when your cost of debt is 6% plus. And most people are leverage buyers. Now it's interesting because we are seeing some interesting buying opportunities, because I mean there are good homes out there. There are less investors that are active in the market, but ones that are, a lot of them are just buying all cash, and they're just buying all equity. And I think there's a belief that they'll be able to finance those, maybe with a 5% ish interest rate in the, next year or so. So, I mean, I do think it's changed. I do think, like, this is probably going back to what investing in real estate normally is like. If you can get like a 50 basis point to 100 basis point spread between your cap rate and your cost of debt, that's usually, that's positive leverage, and, usually considered great. Not, 200 or 300 basis points of spread. Like, that's unusual. So, I think that really, when the market is tighter, I mean, it really puts pressure on operating costs. And I think that's where, Mind and our focus on leveraging technology and just doing things more efficiently, like we can typically charge a little bit less than other management companies because we can do things more efficiently. Like, those basis points start to really add up to, current income for real estate investors. And so, yeah, I mean, where things end, I mean, I guess I'm hopeful that, we're close to the end on increasing interest rates. I know, the market is definitely betting on that, whether that's actually the case or not. I mean, I was not like active in, the market at all in the early 80s. I was, in like fifth grade or something like that. But, everything I've read about that period was, people got a little bit too excited about getting inflation under control before it actually was, and that, the story, or I guess the analogy I've heard is that, like, inflation can be like a campfire. Like, you can't just like put it out and pour some water on it and walk away. Like, you have to stand there with a bucket of water and wait for it to start smoldering again, and then dump some more water and sit there and wait. And sure enough, it starts smoldering in this corner. You got to pour some more water on it. So I just think we just are going to have to be patient in this process of sort of getting inflation back to where the Fed wants it to be, and playing with interest rates might take longer than some people think.
Than they hope. So you work with a lot at Mind. You work with a lot of individuals, right, that are doing individual investing on single family home properties, right? And do
That's
you
right. Yeah, we have, I think, 5,500 investors.
okay? And 5,500, do you does the opportunity change for some of them, or do you, like, in this higher interest rate world, is, or you mentioned that you have cost efficiency, so maybe you're just gaining market share during this time. What do you tell to the individual investors? We have a fair number of individual investors who listen to Altos and pay attention to the data, and but we also have the housing bubble crew really loves us, and they love to go after us hard. What do you tell
Yeah.
to the world, like, those risks, and like, what should we be looking at there?
Yeah, I mean, my belief is like there's not like one message to investors on, like, the ultimate truth of what you should do, because the reality is, like, I mean, with both institutional and retail investors, we serve both. Like everyone's got their own goals, objectives, and criteria. Like it's really unique and different. And so I have to really listen to like, what someone trying to accomplish. Like if you're a long-term investor and you're trying to put cash to work, and you're willing to be one of these all cash buyers, like I think there is an interesting opportunity to go buy properties that are going to have a little bit less competition maybe than in certain markets than they would have a year ago, certainly. And that can make sense. But I mean, if you're a leverage buyer and you need to go use debt, it's just, I mean, you have to be very bullish on appreciation and rent growth. And by the way, I am. Like, I look, the supply shortage is real. I mean, whether it's, I mean, you probably know better than me. I see anywhere from like kind of 4 to 6 million homes short in the U.S. That's real, and it's hard to see how that doesn't continue to drive both rent growth and home price appreciation. But that's somewhat of a speculative bet. Like exactly when that happens and the shape of that curve, I don't know. But you really have to make a big bet on that to go, buy a 5.5 cap home and finance it with 6.5% debt. So, we've seen a big slowdown in retail investment also. And I think for a lot of people, it's a prudent thing to do. I mean, a lot of people have been pretty aggressive. Like I personally bought a lot over the last several years and haven't bought anything in the last year and a half. And I mean, this is kind of how real estate goes, right? It's a cyclical business and we're in the, painful, harder part of the cycle, unless, you were one of the fortunate people that locked in really cheap long-term debt. Because the truth is, there's a ton of loss to lease out there in the market because rent growth has been on such a rampage. Like most investors, most assets portfolios have not been able to keep up with it. So, you're able to continue to grow your cash flow and have like really low cost of capital on the debt side of things.
Got it. So you see a lot of people with portfolios out there who's maybe slowing down their purchasing of homes, but their cash flow on their existing portfolio continues to increase. Is that what
Yeah, that's right.
that's
Yeah, I mean, I own homes in the Southeast, and that's absolutely true for me there. And what I talked about in California, I'm unfortunately, a victim of that too. I have a building in Oakland, and it's not going as well there.
yeah, for sure. Yeah, I have investment properties in Seattle, and I'm in the same boat. Okay, so let's talk really quick about some of those markets. So, which markets in the country are you most excited about? Or like, where do you see
The
either
South.
you personally, or like maybe you see surprising action on the Mind platform that is something that you did like to point out?
Yeah, again, I mean, it really depends on the kind of investor because different investors just want to be in different markets for different reasons. But like Atlanta's been doing really well, a lot of positive job growth there, in migration. We've seen rents continue to grow and prices are still pretty darn affordable. Same in the Dallas Fort Worth metro. Nashville prices went up quite a bit, but Nashville's a great market. Really, all of Florida has been on a tear. We're not in South Florida, but we're in both Tampa, Fort Myers, and Orlando. Those markets have done really well. And then the Carolinas, Charlotte, Raleigh, Durham, those markets have continued to be strong. And, it's the things that I think you might have mentioned earlier. It's like there's a reason why people are moving to those markets. They're like low tax, business friendly, lower cost of living, and good weather.
Yeah. Yeah, they're nice to be there. Although this week I don't want to be in, Texas, but it's 115 degrees, but
Yeah, yeah, Atlanta too. I think is pretty hot.
pretty hot. Okay, so that's really that's I appreciate that view of those. Um, and you've talked a little bit about your long-term bullishness. And of course the book, The Big Long, like it sort of talks about a long term, but I'm interested in, and I ask this of all my guests, like your view of the longer term future, second half of this decade. We've had We had, a real one directional market for a long time. We had millennials growing into their biggest earning and home buying years. What do you see for the market and for even for Mind's opportunity in the second half of the decade? Anything that like the headlines are getting wrong or anything like that we should pay attention to?
Yeah, I mean, I don't I don't know that I have something that the headlines are getting, well, I guess something that's been controversial in the headlines, which I mean, I do kind of think that some are getting it wrong or at least getting upset about something that maybe they shouldn't. And that's the American dream of home ownership. And I just think, like our position on that, my belief on that is that the American dream of owning a home is evolving. It's not dying, it's evolving. I mean, the truth is, for a whole bunch of reasons. One is that, like, renting a home used to be a really hard thing. You had to go to Craigslist, it's entirely mom and pop. You'd have to like get someone on the phone and see if you could see their one house, and then you go see it. And if it's not a fit, then you're back dialing for dollars. It's just a really bad experience. Today, renting a single family home is a lot like renting an apartment. It's a professional industry with customer service and portfolios and choice, and it's a lot less painful. So it's made it easier. I think a lot of people got burned or saw people they know or love get burned during the foreclosure crisis. I mean, to me, it never made sense to like put all of your money into a house to buy a house. That's just, I mean, if you lined up 100 financial wealth advisors and said, hey, should you put all your money in any one asset? The answer would be a pretty quick no. But that's kind of what a lot of people did to kind of sustain this American dream. And I think for those reasons, plus just people want more flexibility, maybe need more flexibility with the way the job market is. We're just seeing more and more people choose to rent. Like maybe even in some cases they could buy, but they're like, I want the flexibility. I'd rather own a couple of less expensive rental properties, maybe in a market I don't even live in, because it makes more economic sense than putting all my money into the one house that I own. So for a variety of, to me, very healthy reasons, the American dream around home ownership is evolving. It's changing. And I think every survey I've seen, people say they want to own a home. It's just later in life. And I think a big part of, Mind's value proposition is really enhancing that experience, making the service as easy and, seamless as possible, so that as more and more Americans rightly choose to rent, we can do a better job of making that experience more seamless. I think in terms of, the supply shortage that we talked about, I mean, that's going to continue to fuel home price appreciation. I mean, I do have this fear that like home prices and wage growth just, are out of sync, and it's going to become actually harder for people to buy homes. But what we're seeing in our industry and kind of, the really new exciting sub-asset class within single family is build to rent, right? And so the idea of build to rent is, I mean, I remember that I got invited to the big PCBC builder conference in San Diego. I mean, I think it was literally like 2010, 2011, and they wanted me to come talk about, in those days we called it B2R, build to rent. That got changed to BTR. And I was talking to these home builders, and they were just like looking at me cross-eyed, like, why in the world would we build a house to rent? Like, that makes no sense. We sell to homeowners. But like that is really taken off. And I think part of it is, as institutional capital has come in, even though we've shown that there are real efficiencies and that the scattered site, single family rental can work, they're still more accustomed to investing in large apartment buildings with economies of scale. And it's interesting because build to rent is basically a horizontal apartment, because you end up with, maybe a couple hundred homes in one community, and they're all rentals. And we just can't get enough rental homes to meet the demand of the market without building our own supply. The truth is, you just can't buy, investors can't buy enough already built homes and convert them to rentals to supply demand. And so what we're seeing is a massive amount of build to rent construction happening, companies being created. The capital is attracted to it because it looks more like apartments. We call it we call build to rent the gateway drug to single family rental. Build to rent is just one flavor of single family, and our belief is they're going to try it out with build to rent because it looks more familiar. But then once they get into it and see the dynamics are safe, then they're going to want to get into scattered sites and build a portfolio. So I think more build to rent is going to be something that you're going to see. So like lots of really amazing choices with like brand new rental homes with amenities, much like you'd see in an apartment building.
Yeah. And you said something interesting in there that I want to touch on. We've talked about the shortage of homes that are available on the market to buy. We talk about shortage of homes that are, we've been underbuilding since the great financial crisis. And then, but you said you really feel a shortage of homes that available to rent. Like you feel a shortage, you have more renters, people who want to rent single family homes than are available for them to rent. Is that true? You feel a shortage of those as well?
Yeah, look, it's always like a market level conversation of supply and demand at a certain time in a certain market. But our average days to lease has been around 15 days, pretty steadily throughout the year. And in my time in the market, like that's pretty fast. And so yeah, it got challenging last winter, but kind of at the same time that we saw the housing market pick back up, we saw demand for rentals and rent growth pick up as well.
At the same time, sure. It's people have a misconception that purchases and rental is counter-cyclical to each other, but it's really like people are buying houses, they're moving out, they're creating households, they're doing both at the same time, and we see very often them move in tandem. Well, so look, that's really interesting stuff. I appreciate your view of the future, and it sounds to me like that in this vision where the American dream is shifting, that the American dream is what you're saying is sort of like it's about the autonomy of having my home, where I either I own that home or but if I choose to rent it because it's now easier to do so, like that can be part of the American dream and of a good lifestyle, a good quality of life, and have that fit into the
Yeah.
mix.
Yeah, and I think, the opposite side of that coin is like the renter, right? So like another way of saying it is we're trying to decouple the house that you live in necessarily having to be the house that you invest in. Like, why can't it be that like renters choose to live in a certain area? Maybe they want to rent because they can, afford to get into a school district that they want to be in. But that doesn't mean that they shouldn't own a home. Like, work with Mind, we can help you buy a rental home and we'll manage it for you. We'll help you pick a market that makes a lot of sense based on rental demand. And so people are owning homes, they just might not be living in the home that they own. And I just think, when you read the headlines, there's just a lot of consternation about like what's happening, the erosion of the American dream. And it's like, I think if you really double click, it's like, it's a pretty healthy evolution of the American dream that makes a lot of sense.
I love it.
And we're just trying to be a part of helping people to, make that move forward.
Yeah. The headlines also can be critical of the institutional capital in single family homes. And what do you say to that, to those criticisms? What do we talk about? How should we look at that?
Yeah, it's a super, easy criticism to make.
Yeah.
But I think there's
two landlord, right?
there's two pieces.
It's
There's two pieces to it. One is, and I was there. I was on the ground level. Institutional capital may have saved housing in America, maybe even save the economy. Because like what happened during the foreclosure crisis, what happened in the book that we taught, in the Big Long, it won't happen again. It can't happen again because now you have this like massive amount of institutional capital that's basically creating a floor. As soon as prices get too low, that capital is just going to flood into the market. And so it's actually stabilized the market and saved the market. I mean, we used to get hugs from neighbors. We'd come in and buy these dilapidated homes, which were nice homes. Now they were, being lived in by people who were basically, trying to steal the house and live in these homes illegally with, that were all boarded up. We would come in and we would buy them and put $20,000-$30,000 in them, nice landscaping. The neighbors would literally come out and thank us for like saving their neighborhood. So that's one. Two is, I'm yet to have a conversation. Like, we just don't get our retail investors. So like the mom and pop landlords who, many in the media feel like, well, that is who should own these homes. They're never coming to us and asking to us about service levels and like upfront saying, what are all your policies and procedures? How do you deal with X? How do you deal with X, Y, and Z? Those are just not conversations we see. But with every single institutional investor, they want to know, they want to be sure that we are providing a good service and that we're taking care of our residents, we're treating everybody fairly. Like, they want to see our manual, they want to understand our policies and procedures. They really care about it. And so it's like, single family rental is hard. Like, there's all these scattered homes and, it's not like an apartment building where you can very like super clearly see issues. Like, there are challenges to it and it's never going to be perfect. So it's always easy to find an outlier example of like where someone didn't get it right. But what I can say is, institutional capital wants to get it right. And people also have to remember, institutional capital is pension funds for firefighters and teachers. And, they're investors. Like, we're basically, managing investments for teachers and firefighters and police. This is what we educate our team at Mynd about so that they, get excited about the fact that we are representing institutional investors. I don't think that they're the villains that they're often portrayed as in the paper.
What a surprise! But yeah, that's a great perspective. You mentioned they create a floor, and a year ago, and a year to 10 months ago, and I would do these conversations on the podcast with folks, and I was asking them about what they would think of. We could see the market softening in the second half of last year, very obviously, and my question was: is the capital out there going to create a floor, or come in and see like, oh, our cap rates are a little better, let's go buy? Or is the capital going to get afraid and everybody shut down at the same time and exacerbate the downturn? We had a floor this year. We could see that people were buying it, and not just institutional, but like homeowners were buying homes this year more than were for sale all year long, and it was a big surprise. So in the next phase, though, let's say recession hits hard. Let's say, at the beginning of next year, and maybe rents adjust down, home prices tick down. Is there risk that the institutional capital all stops at the same time, and therefore exacerbates the next phase of downturn? Or am I?
I don't. The institutional capital, is down 90%. They all did. They did stop at the same time, and it wasn't really because of the reasons that you cited. It's the math not working. It's like, as soon as there became uncertainty around the cost of debt, these are typically leverage buyers, and it is about how do you buy with positive leverage. And as soon as that became tricky, and it was clear that like cap rates couldn't possibly move as fast as the cost of debt, I think that was what made everybody say, whoa, tap the brakes. Well, first it was tap the brakes, and then it's like, we just need to see where things land. Ivy Zellman, put out an estimate, 4 or 6 months ago, like she believes there's like $80 billion of dry powder on the sidelines, not looking to get into SFR, but with a mandate to get into SFR. Like, we see that these groups have a mandate. It's like an asset class now, and everyone's kind of underexposed. And as you look at real estate, single family rental stands out as like, one of the most compelling, if not the most compelling, from just pure fundamentals. So I think as soon as there is clarity around the cost of debt and neutral to positive leverage that can be achieved, you're going to see a wave of capital come in. And it'll look a lot like 2011 that you and I were just talking about. As soon as Blackstone and Starwood and Colony, part of it is the math working, and part of it is like, what's Blackstone doing? What are these big blue chip, is Invesco all of a sudden like they're all in buying, and, everyone's going to feel like they're missing out. And, what ends the supply shortage we have? Like, I don't know. That's hard to say. I mean, there's a lot of vacation homes that were bought during COVID with, I think, outsized expectations on rents and revenues. And, we've really seen those revenues and demand go down. I mean, there's millions of those vacation homes out there. Like, what happens to those? Do those owners have to sell in some kind of distressed fashion? I don't know. But like, I just know there's a lot of capital on the sidelines. And as soon as the math works for investors, I think you're going to see a real wave of capital come in.
See it come back in. Well, that is optimistic. That's really, really great to know. A great note to wrap up on. Doug, I appreciate your time very much. Where can people go find out more about you, about Mynd? Are you social media?
Yeah, so LinkedIn's a great place for me. Mynd.co. We missed out on .com, unfortunately. We were raising our first round of capital like right when it got taken, and I'll never forgive myself for not just putting up the 25 grand. So we're Mynd.co. And we're out there on social media. Pardon? Yeah, mynd.co. And yeah, I mean, if you're interested in learning more about single family rental, or, getting in the game, preparing yourself. And what I always tell investors is like, you need to do like, at least 6 months to a year of like education, finding the right partners, figuring out, there's a lot of work that needs to be done. What do you want to do? What do you have time for? What do you want to have partners for? What's your strategy going to be? Start making some lowball offers. Like, get in the game. It's hard to like sit on the sidelines and know what to do. You got to get out on the field and start making offers. And then you're really ready when that deal comes through and you're like, oh, I've seen so many. This is the price. This is the location. I'm going for this one. And so I say be ready. Like, sharpen your sword. I don't know when what I just described of the wave of capital, like I am highly confident of that. I do not have a lot of confidence about when. Yeah. Timing is murky, but like get ready now. So when it does come, you're ready. And we're happy to talk to you about it.
Fabulous. Really, really great. Appreciated a lot of all the insight. And thank you so much for your time today. Again, everybody, this is the Top of Mind podcast, the Top of Mind with an MIND. And if you enjoyed the show, please give us a like, write a review so that it helps other people find the show. Again, my guest has been Doug Brien, the CEO founder of Mynd. And we will be back next week. Thanks, everybody. Thanks for listening to Top of Mind. If you enjoyed the show, I'd really appreciate leaving a nice review on your favorite podcast app. That helps other people find us as well. Be sure to subscribe so you don't miss future episodes. See you soon.